Happy Thursday. This is John McEntyre. This is John McEntyre Live. I'm John McEntyre on John McEntyre Live. Let's get that script right. We're not going to have one of those yesterday's situations where I was halfway sleepy, um, even though I had a good night's sleep. But yeah, welcome. Today is Thursday, June 13th, almost the middle of the month. Yeah, it's moving along. We'll be mid-month before you know it. And today I'm going to cover some wallet wins, celebrate some wallet wins. I'm going to do the question, answer a question that came in. It was about credit. Then we're going to do the question of the day. So let's get into the first wallet win. First wallet win, we are paying cash for our daughter's wedding. That's a serious wallet win. I know a lot of people out there that are, especially moms. It's the mom, the dad. He's nervous too, but his is a little bit different type of nervous. The mom, she's already stressed out. It's like she's getting married over again, and so she's all a nervous wreck. So to actually know you're paying cash, that would calm my nerves some. Definitely calm my nerves, especially with the cost of weddings today. Well, it's like the average wedding cost is like $20,000 or something like that. Yeah, knowing that I don't have to finance, and then some people are financing $20,000. I'm like, so I couldn't get with that. Couldn't get with that one. Paying $20,000, knowing that the money is saved and paying cash and it won't incur any interest on it, works for me. So wallet win number two, my car broke down and I had the money to have it repaired. That's what sinking funds, emergency funds, that's what they're all about. It's taking care of those situations. Car breaks down, some major repair, because most of the time if a car breaks down, that's something serious going on. And so I actually have the money to have it repaired, no stress on you. So hopefully they've taken care of it. Get the sinking fund or emergency fund, whichever one they had to use, to build back up and get ready for the next one. Because like they say with Murphy's Law, something's coming down the line. It may not be big, it could be something small, but there's something that's going to happen. And that's why you need those emergency funds and sinking funds to take care of those unforeseen situations. So wallet win number three, just saved my fourth month of living expenses, and my goal is to have six. So yeah, that's a serious win. 4 months, you're ahead of a lot of people. You're ahead of 80, 85, 90% of Americans just by having a month. You'll pass 70%. But to have over 3 months, yeah, you're up in the top 5% of people that's financially healthy, just off of that, having those living expenses saved up. And to have your goal, the goal is to have six. Yeah, you're well on your way. So three good wallet wins for today: paying cash for the daughter's wedding, car breaks down and had the money to have it repaired, just saved the fourth month of living expenses with the goal of having six. And so thanks for those wallet wins. Don't forget to share yours. Put them in the comment, or share, on social media, on, wherever we go live, YouTube. Make sure to put in front of it hashtag wallet wins. Also with your questions, don't forget to drop those questions in there. Put a Q so that we can see it and be able to answer it. Because if we're just receiving, comments, we do check everything. When we put wallet wins and questions. We make those the priorities to share those. So some people, they make comments when it's really a wallet win. So, and we may just not take it as a wallet win. Put the wallet win in front of it so we'll know what to do with it. Hashtag wallet win. All right, let's get into this question that came to me, which is, I paid off my car early and my credit score fell almost 80 points. What gives? Confused. Yeah, that is confusing. Um, it's confusing, perplexed, um, just baffling. Any other superlative words? I don't have a lot of big words in my vocabulary, so I'll look up some more I'll bring my dictionary the next time. But yeah, that is perplexing. But there's actually an answer to that. When I learned a long time ago, I actually had a credit specialist on the show. This was back when I was on television in Charlotte. I had a credit specialist, and we talked we talked quite a bit about that because, as a matter of fact, it actually happened to me one time, and I was like, what is going on here? Haven't made any late payments or whatever. I'm actually doing the right thing. So why did my credit actually fall? And so it was explained to me. Just a quick thing about credit, quick overview about it to really set the answer up correctly. You first start out, you basically what they call credit invisible. You have no credit. Credit score is zero. It's really not even zero. You just have no credit. You're credit invisible. Zero means you did have some credit. You are somewhere on the books. Maybe you've paid everything off and decided to go creditless, to not use credit at all. So it goes down to zero. But before that happens, you're credit invisible, which means you're not even on the radar of credit yet. All right. So to become visible, you need at least one credit account open for 6 months or more, and the credit account has to have been reported by the credit bureau within the last 6 months. So that actually, now you're on the radar of credit. It's low, the score is low, but you are on the credit radar now, whatever the credit score is. So if you don't do anything else, the credit score will stay there. If you're making it may go up, a little bit, but not a lot. If you're making your payments on time and you just have one credit account open, it's going to stay low. Now, you start building your credit. You're using credit. Now, maybe you purchase a car, you purchase a home, different, and you're open up. Maybe you a charge card at a department store or something like that. Now your credit, and you're making your payments on time and everything. Now your credit score really starts to climb. It's starting to go up because there are percentages that works within a credit score. 45% is paying on time. Another high percentage, over 30%, is the actual type of credit that you're using, and you're keeping it in a certain parameter. You're not overusing your credit line, for lack of a better term. But in this particular case, what's going on, what I've seen, what was explained to me, is usually three things. You have 15% of your credit score is made up of what is called average credit age. Average credit age means how old are these credit lines. So if a lot of your credit is young, your credit score won't be as old because it hasn't been reported a lot as much. And say, for instance, a mortgage that you've been paying on for 5-10 years, it has some age on it. And so it really affects your credit more and more and more. The younger ones, they don't affect it as much because they're just young. You just haven't made enough payments. So what they do, they take an average. So they take the average of all of your credit and put it together and say, this is the average age of your credit score. This is the average age of your credit. If that's the case, maybe the car loan you paid off was one of your older credit lines. And since it came off, you had a lot of younger ones. So the younger ones they're still there. Your older one went away. So your credit average went down. Your average age went down, which can cause a credit score drop. Right. So that's one of them. Average credit age. And that's what it sounds like. It could be that one, depending on what percentage drop, because that's usually 15%. So say, for instance, your credit score is 750. All of a sudden you paid off your car, it drops down to 770, drops 75 points. It could be this other one is coming up, or it drops down to maybe 70 drops 75 to 80 points. Let me get myself together here. That could mean the credit age was affected. So that could be it. The next one is it could be credit mix. Credit mix accounts for 10%, which means I equate it to being in investing. If you have a one stock, you're not diversified. A mutual fund or index fund is diversified. So that's what credit mix is also. If you have all of your credit is made up of credit cards, you don't really have a credit mix. You have credit cards. But if one is a credit card, one is a car loan, one is a mortgage, now you have a higher credit mix. It's more diversified, so your score can climb by you making your payments on time and everything like that. That can make, and that accounts for 10% credit mix. Now, if you paid off the car and your credit score dropped, this could be it also. Your mix has fallen. Maybe it went from 4 to 3 mixes, or 3 to 2, whatever. That could also be the cause. Also, that could be 10%. So we go back. If your credit score was 750, it dropped 75 points. That could be the one. The credit mix has changed. You're not as diversified in your credit. And that's why I tell people is, if you're going to use credit, use it wisely and use it properly. And if you're not going to use it, just don't use it at all. If you're going to use it, have a healthy credit score. If you're going to have those poor credit scores, just do away with credit, period, or get serious about building the credit. I know people on both ends. I know people that don't use credit at all. They've gotten a mortgage without a credit score and everything, because there's ways of lending and using money out there without a credit score. It's other ways. It goes back into, it's like old school lending. It goes back into manual underwriting. Is basically what it is. So those are the two. Now, you going back to the early one, this could also be one of them. You're just credit thin. You just don't have a lot of credit, is what it is. It's not about the diversification. It's not about the age. You just don't have a lot. You could be the car. Since I don't know a lot of details, for instance, this is a scenario. If your first venture into credit is a car loan, you're younger and you buy a car. Okay, you pay it off, but that was the only credit that you were using. Okay, your credit's thin now. Your credit score is going to fall. It's just not. It's not. Credit scores aren't really static. They're constantly changing. I go back to when I was talking earlier about the mutual funds. Credit is almost like it's like the stock market. It depending on what you're doing, it's going up or down. And most of the time, it's not doing like straight going up. It's like doing like this because you're paying things off. You might be paying things late. Or you could be doing things well or whatever. So it's like it's just doing its thing, but it's never a straight line. Credit is pretty much just like the stock market. It doesn't move in a straight line, and that's what it could be. So that could be one. Those three is usually when something happens with credit. If you're doing everything right and your credit score falls, that's probably it's one of those three that I was just talking about here. Either your average credit age has fallen, credit mix has fallen, or you've gone back to being credit thin. Your credit, you didn't have a lot anyway. Now that you paid this off, you got credit thin. So that's why I say, if you're going to use credit and you paid off the car and you don't have a lot of credit, then it's okay to get a credit card, use it each month, pay it off, and pay it off. And that way you can keep your credit moving, on an upswing. Like I say, if you're going to use it wisely. If not, just go to zero. Or don't use it. Just say, because if your credit score is low, you're going to pay high interest and things like that. Even if you said, well, I paid it off, but your credit score is low, we're still sort of taking a risk. You're still considered a high risk. So it would be better to just say, I just don't use credit and I want to use manual underwriting. And you just make the request. those manual underwriters, those companies they're out there, but it takes a minute to find one that really knows what they're doing. There's plenty of them out there, like I say, but you just have to take your time and make a decision. I'm going to use credit, and I'm going to use it wisely, or I'm not going to use it at all. Or I'm just going to use it for this particular situation, for a home, something like that, where the manual underwriting will really be very important with this situation. So I hope that answers the question. Um, I did best I could. That's what I was taught from my credit specialist from years ago. And so hopefully that did answer the question. If you had more questions about credit, don't hesitate to give us a call. We'll talk it through, or we'll guide you in the right direction there. So the question of the day, I want to feed it off of that. We're talking about credit. So the question of the day is, how often do you check your credit score, if at all? Because it used to be a time you pulled your credit one time a year free, which you still can. You get your full credit report free. Excuse me. But today you have so many different. You have Credit Karma, and different types of those credit monitoring services. So now you can actually go in and look at the account every day and see if your score is changing. And that's my question: how often do you check your credit score? If you say not at all, then at least pull it once. You get one free one, your full credit report free, or join one of those companies. I mean, even your banks now, if you have accounts at your bank, you can go to the bank and have your credit, without it affecting your credit being pulled. Because that's why some people say, well, I don't want my credit pulled. I don't want to check it because that could affect my score. Well, there's certain ways now, if certain entities doing it, or if you're using a credit monitoring, then no, that it doesn't happen. So things have definitely, that's the beauty of technology today. And I'm quite sure that AI is going to get more and more involved in this. And it'll probably tell you every day, hey, your credit score is this today. And now I'm nervous because you know more about me than I know. And you're supposed to be artificial intelligence. But that's just a little something. I've been having that AI conversation a lot lately. And we're basically just going to have to keep talking about it. So I hope I answered the question. Answer the question of the day for me. How often do you check your credit? If you need any guidance, information, educational guidance for your finances, give us a call. Contact us. That's whether it's insurance, your estate, whatever you're investing, whatever. Give us a call. We'll help. We'll do the best we can to help you. So we'll see you tomorrow. Tomorrow will be Friday. I'll be sharing a book. And this is John McEntyre signing off. Have a good day.